Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me is Peter Armitage as well as Bryan, both from Anchor Capital. And today we're talking offshore company AutoZone, not to be confused with the local company which also goes by the same name. Not only do they share the same name, but almost a similar business mandate, I take it. Bryan, maybe if you can give us perspective on the US-based AutoZone.
Well, they're very much mirror images of each other, the local and the international, but no link, as we've said. This is an auto parts business, catering to the do-it-at-home mechanic and also some of the smaller shops. So if you're looking for spark plugs, this is the kind of the place that you would go to. If you're taking your vehicle to a private mechanic, he's going to get his parts from a store like AutoZone.
Maybe if you can walk us through some of the metrics. Clearly it's a company that has a lot of access to all vehicle owners in the US, but looking at the numbers, market cap looks quite high.
Very much so. I mean, you think this is just a vehicle parts thing, but it's $21 billion company. So quite a big business. They have over 5,000, just under 5,500 stores across the US, Mexico, and then just a few into Brazil now. So very big business, growing, increasing their store footprints at about 5% per annum. So it's about 250 stores every year that they're opening. Forward multiple, a little bit on the more expensive side that we've seen it previously at about 17 times. But you know, it's one of those good businesses and still growing.
Interesting that you touched on that emerging market kind of entry that they're doing, Mexico and Brazil. Is this something that you might like, Peter, the diversification of the geographic locations?
Yeah, I think first and foremost what you're buying is the US. That's 95% of its value. And you've got to take a view on that. And we'll come back to, this is more than just a business. It's kind of a corporate finance case study. But we'll come back to that. But from a business point of view, you know, the expansion into Brazil and Mexico from a numbers point of view, you know, there's more people in those two countries than America. Conceptually, if you take a 10-year view, it expands the growth potential of the business quite nicely if they can get it right.
Talk us through that corporate finance company example.
So this is a business which has made half of its earnings out of the business and half of it out of the way it's managed and engineered its balance sheet. It's produced 34 consecutive quarters of double-digit earnings growth.
34?
Which is absolutely remarkable. And they've done this through a combination of, the first point is the business is quite steady. If you can picture the car population, your car breaks down, you need to fix it. So there's a nice steady base, but it hasn't had dramatic turnover growth. So you're talking turnover growth in around the 5% level, which is roughly in line with new stores. So the existing stores kind of chug along and make the cash. Then they've taken that cash and they've bought back their own shares. They don't declare a dividend. They've halved their number of shares over the course of the last 7 years. And that's resulted in the earnings growth growing and growing and growing. What they've also done is used a bit of debt every year to buy back. So if they're making $1 billion odd in cash, they buy back about $1.4 billion of shares. So the debt's been going up and up, but the combination of those factors has given you almost unprecedented and incredibly impressive earnings growth. So I guess the question is the core business and then the philosophy of doing that and the way that they've created value, whether that's sustainable over the long term.
If you're not buying it for the dividend, then what might motivate you wanting to put your money in this company?
Enormous share price growth. You know, the result of that 34 quarters of consecutive growth has seen the share go up close to 10 times over the course of the last 10 years or so.
Bryan, maybe if you can tell us more about that, because looking at the historical PE, share price rather, and the PE ratio, the price has been steady, but the PE moving up and down as we see as a trend.
Well, it's one of those, you know, your multiple is going to move as they release their earnings and they grow, and yeah, it's been a relatively well-priced business. It's got an average multiple of just under 18. So on a forward basis, we're looking roughly getting back to average. Currently trading at about a 21 times multiple. So we're above the upper end. So it has gotten a little bit more expensive, but that's kind of been the world we've lived in. If you wanted growth, you've paid up for growth. And this is a company, although partly engineered, has been growing. So it's done very well from a share price perspective. It's a very defensive stock in a certain way. And when times are tough, people are not buying new cars, they're fixing their old cars. This is where they're going for business. The US, when they've had cycles of the weather, you know, bad weather, salt on the roads does damage to vehicles. This is good for AutoZone. So they seem to be quite a defensive play in certain instances, and the share price has gone one way for over the last 10 years, including in 2008. So it's been a very good performer. As Pete rightly pointed out, it's gone from about $80 to $700 in that time period. And as I say, although we're looking a little bit expensive at the moment, on a forward basis, we do return back towards a more normalized and average PE. But again, you're paying for growth on this company, which is a theme globally at the moment.
If we look at the growth initiatives, I want us to walk through the commercial side versus the retail and even the international expansion and the cost management, which Pete just alluded to earlier on. Clearly, it seems as though they have a very sustainable business model going forward. You mentioned when it's bad, it's good for them. When it's good, it's great for them.
That's the thing, they've got two sides to their business. The majority of it is the do-it-yourself mechanic. So he's going in, he's changing his spark plugs, he's maybe doing a cam belt or brakes or something like that. And then a smaller portion of the business, which is about 15 to 20%, is the commercial side. And this is the area that's starting to grow more and more. They've got initiatives for returning vets in the US to assist them in starting own mechanic store shops. So it's a very much a core focus for them is the commercial side. They only own about 2% of that market. So the upside potential is unbelievable. I mean, it's a $52 billion market. They're getting $1.5 billion worth of revenue out of it. So the upside there for them is massive, and they are actively pursuing that area. It has been one of the bigger growth areas. And then, as I say, they're the dominant performer in the do-it-yourself space. So they want to hold on to that space. They want to hold on to that market share whilst really driving the commercial side.
What about the competitive environment here?
So I think that's they're sitting with just under 20% market share. It's the kind of industry where, you know, if I had the passion for it, which I don't, I could go and open a spare parts store. And the barriers to entry are not that high. But I think when you get scale, you get barriers to entry because you can buy cheaper. You've got logistics and integration kind of benefits. So I think if anything, they can increase market share. But I think that's what's nice about this business is it kind of does one thing. You know, we have a lot of these kind of illogical conglomerates in South Africa, the Bidvest and Imperials and Barloworlds, and a lot of them have unbundled, but it's because South Africa is small. So if you do spare parts and you own 20% of the market, that's a small business. You need to do something else. In America, where there's scale, you can do the one thing. So you can go, we do that, and you can grow the business by 5 or 10% every year for 30 years because America is big enough. So they do one thing, they do it very well. As they get bigger, they get the benefits of it. And that counters the kind of competitive edge perspective. And it reduces your business risk significantly because they know their business. They're not out there issuing shares to buy new things all the time. Their shares in issue have halved with their buybacks. So you know what AutoZone is, you know what it's exposed to. It's a nice consistent underlying theme. And in our offshore portfolios at Anchor Capital, we've had it in just as kind of a banker share since we started.
Wouldn't you want them to expand though? Doesn't it make for a very lazy balance sheet, or is it the contrary?
Well, they're using the balance sheet to do what I talked about. So they are expanding in a way. They're buying somebody, but the person they're buying is themselves. And they're buying their own shares because they know what they are and they're confident in that. So it's something different. You know, you can buy, a lot of people like businesses that are buying a lot of other things. That also comes with a lot of risk. Generally, people say in the market, the number is 60% of acquisitions are unsuccessful. They make a very successful acquisition every year. That's themselves.
Something that they know and something that they can adapt to.
And they're rolling out the store base. So this is a growing business. They're continuing to expand. They don't need to go and try and pick something auxiliary on the side. They know they
integrate management and work out get the khokos out. They're just opening new stores.
They open stores, they buy back shares, they know their business, and they're doing it well.
And they're flexible enough to go online as well to keep up with the ongoing trend of e-commerce.
Yes, it's been one of their core drivers at the moment is this online expansion. They've recently, or not so recently now, a couple of years ago, went and bought an online portal, Auto Anything. They also own a company called All Data, which does the manuals for vehicles. So if you're looking at a Mercedes C-Class in the US, you can go and download the manual, and that manual is available to somebody in Germany around the world. So they literally, it's a small part of the business at the moment, but it's a growing part because they can now access the world. Anything auto, again, online, it doesn't take much to send spark plugs.
You need the physical presence. Yes. I mean, there's that kind of romantic notion of Mark the mechanic in his grubby outfit. He wants to drive down to the local store and pick up his spark plugs. But it's clearly the the internet world does have some future for him.
Exactly. Well, after that interesting analysis, time to get the big question answered from our analysts. Buy, hold, or sell? Bryan, buy, hold, or sell AutoZone?
I think this is a company that I really like. If you own it, you're definitely going to hold it. I think it now, buying it at these levels, with understanding what management have been doing and whether it's sustainable going forward, I think you got to be cautious on it. It's a stock that I do like. I would hold it definitely as a core part of the portfolio. I would add to it. I would build it over time as a holding position. And
wait for it as well to get slightly cheaper to get into a buying opportunity. Pete, do you agree? Buy?
So I want to hold it in my portfolio. In our offshore portfolios, we hold it. The price has gone perhaps a little bit out of range, and US shares are volatile. So it's the kind of thing, pick up your Bloomberg's phone, put it in your watch list. When it comes off 10%, buy it.
Download the CNBC Africa app. But
there
just to close off with, there's the future of this potential company, buying your cars online. We heard about Mike the mechanic and him wanting to touch and feel his spark plugs. But hey, people are working into a virtual environment, so maybe that might be the future for them.
Sure.
Well, we'll hope so. Well, that's where we leave it today for Talking Stocks, taking a look at AutoZone, which both our commentators agree on. Hold, and if it looks cheaper, maybe pick up a few more. But do join us again next time where we talk more stocks.